Well, a very good morning to you and welcome to CNBC Africa. Today we have the Rwanda Monetary Policy Committee meeting and we are going to be bringing you the special broadcast as it starts any time from now. And right now we would like to cross over to our very own CNBC Africa's Eric Sheka, who is on ground to just give us insights on what the traders are saying when it comes to the Monetary Policy Committee outcomes and also a look at how this year has performed so far. Eric, over to you.
Good morning, Tabitha. It's a lovely day in the morning here in the Central Business District of Kigali, the economic heartland of the country. Most of the businesses here will feel the impact by the decisions of the MPC today. Now, we talked to different traders who their expectations vary. Some think that the central bank will maintain the status quo of the repo rate, while others think that there might be a hike due to inflationary pressures. There's also been a major concern regarding the currency depreciation, which stood at 6.5 by September. The franc has been weakening, but the central bank says that this reasonable depreciation is necessary for enhancing the exports. We are here on the ground. The optimism is there. Most of the traders are optimistic about the economy, which registered a 9.8 growth in the last quarter. So we'll be here, posted here, and we'll be keeping you updated. We'll be giving you most updates as they come, and also looking at how these traders will reflect on the outcomes of the MPC today. Back to you, Tabitha.
All right, Eric Sheka there, and later on we'll be crossing over to Abe Agena, who is on standby, where the MPC is set to take place shortly. And all right, we'd like to get straight into our conversation, and we're joined by Kevin Garobia. Kevin, thank you so much for always coming to us with your contributions on the Rwanda Monetary Policy Committee meetings and also the markets update. But I'd like to get your view, Kevin. Let us take stock of how 2024 has been like for Rwanda. Let us look at it from an MPC perspective. So far, you've had 50 basis points cut this year. So from this quarter, the last quarter of 2024, what are your maybe expectations?
Yeah, thank you for hosting me as well. So looking at the Rwanda space from an economic analysis point of view, given that the MPC on one hand trying to make sure that there is price stability, inflation is within the BNR's target range of at least 2 to 8%, with a midpoint target of 5%. And in 2024, we've seen that inflation has sort of settled into that range. We were coming from a period of high interest rates in 2023. We saw in February, the MPC made a decision to the first cut in February, 50 basis points. Since then, inflation has come down really. We're now looking at an inflation rate of 3.8% for the month of October, and that's year on year, though a slight increase from 2.5% the previous month. So from an inflation point of view, which is the main purview of the central bank, inflation has settled within the target ranges. If we look at economic growth, which is also a key factor or a key to look out for, we're looking at 3 quarters of more than 9.5% economic growth, year-on-year economic growth, which is a strong indicator for the economy. It shows an economy that is resilient, an economy that continues to recover from the shocks experienced in 2020, and this has also generally supported MPC decisions, given that the economy is growing at good or stable rates. And that has also fallen into the hands of the MPC.
And Kevin, looking at the BNR annual report for 2023-2024, the year commenced against a backdrop of global economic uncertainty. And I remember John Rwamgambwa, the governor, saying that the Middle East crisis also affected or impacted the business here. So let us look at maybe how the businesses are likely to perform, maybe domestic inflation. What are we likely to see?
Luckily, domestic inflation is largely driven by food prices. And in 2024, harvests have been strong. We are looking at very strong seasons. If you compare to previous periods, looking at agricultural growth from a quarterly GDP point of view, in quarter two was also very strong. Quarter one was the strongest that we've had in almost 4 years. So food prices have sort of moderated, which has played a lot in maintaining that impact of local inflation. As for the exported inflation was definitely expected given the geopolitical tensions, given the fact that we are dependent on other factors outside the Rwandan economy to determine some of these prices. So fuel prices have been fluctuating. There's been some volatility. And when they were high, they definitely contributed a lot to the imported goods index, which weighs about 33% in the CPI basket. And also some other policy decisions, although that was internal, that saw like transport prices hike. But if we were to look at the imported goods only, then definitely the volatility of fuel prices played a role in some of the high inflationary pressures.
And comparing it from a regional perspective, how can you say maybe Rwanda has performed in that area?
Looking at the rates regionally, we've seen that inflation has also come down. Looking at averages of 3% in Uganda, 3% in Tanzania as well. Kenya is also experiencing its lowest inflationary pressures for a long period of time. So generally in the region it has come down. Rwanda's inflation was stickier than their regional counterparts, especially in 2022, 2023. We're looking at double-digit inflation rates. And it's also quite impressive to see that they have also sort of caught up with the regional neighbors in terms of price stability.
And also, Kevin, I'm looking at the annual report, still 2023, 2024, and despite the high inflation that we saw, or Rwanda saw, rising interest rates, let us talk about the currency fluctuation. We started with a strong US dollar, and I remember Kenya's currency was the worst performing, but right now it's amongst the best performing currencies. But our focus is Rwanda. The franc has been also impacted by the strengthening of the US dollar. How can we say we are at looking at the franc performance so far?
So given that Rwanda is a net importer, which similar to the other EAC countries, it was expected that definitely with the stronger interest rates in the US, we are going to have a stronger dollar for a sustained period of time. And definitely affected from a currency perspective. Rwanda's currency depreciated a lot. If you look at 2023, depreciated by around 18%, which was also high, but not higher than Kenya, but also significantly higher. But we've seen in 2024, in as much as the dollar has maintained its strength, has been boosted so far by also some of the outcomes that we saw from the election on the US side. You're seeing that depreciation is still slower. It's slower than what we had in 2023. Looking at year to date, the depreciation rate is at around 8.3%. Similar period last year, we were well into the double digits. So it's been a bit positive in 2024. But also the last period to the year will also be critical, given that we are seeing the dollar strength is back. The DXY is up more than 5% on a year-to-date basis. And it will be a wait and see, really. But we expect the continued currency pressures to continue.
Indeed, a wait and see, continued currency pressure. But I am also keen on the issue of a lack of dollar flows in the country. So from a trader's perspective, investment analyst perspective, what could be leading to this lack of dollar inflows?
It's
Actually, it is a shortage. You've had quite a shortage in the Rwandan market. You know, you go to the bank, you exchange your Rwandan franc to the dollar, lack of dollars. So what can we say is happening here?
It's the FX liquidity crunch is usually expected, especially around this period. Also, as we build up towards the end of the year, because that's when also a lot of imports are being done. So there's a lot of competition in terms of sourcing dollars from the market, and it's expected that definitely with higher demand for dollars from importers, then it definitely squeezes the liquidity from an FX perspective. And this started in around mid-August. I remember at one of the meetings, posed the question to Governor. Yeah, and they also mentioned that they had also tried to increase the supply, what they inject into the market, just to try and ease liquidity. But still, as we can all see, it's still a bit tight.
Yeah.
But in most of the economies that are importers, then this period, the last quarter, is definitely usually has a lot of liquidity strains in the FX markets.
All right, Kevin Karobia, let us now cross over to the Rwanda MPC currently taking place.
The outcomes of these two committees, does that have to be on, that microphone? No, I mean, there's a microphone that is switched on there. Okay. So again, as we are used to, we use a short presentation to communicate to you the outcomes of the two committees. So the slide here shows just the outline of our presentation. Briefly on the global economic situation that in a way impacts on what happens here in our economy. Nothing much has changed since we met here in August, and the global economic performance remains subdued because of the challenges of the past shocks. So we had the shocks of COVID, we had the shocks of the Ukraine-Russia war and high inflation. So central banks took measures to curb inflation that has had a negative impact on the overall global economic growth. So as you can see, it remains around 3.2. Even next year is expected to be around 3.2. Sub-Saharan Africa doing slightly better, but still far below what we had pre-COVID times. But we expect to see at least stronger recovery than we are seeing in the rest of the world. And our main focus is on the prices now and the inflation. We see commodity prices continuing to reduce. Last year, we had a reduction in commodity prices. We expect to see that continue this year. Though we had a slight increase on global energy index in the second quarter of this year, the reduction continued in the third quarter, and overall we expect to see a negative 5.8 reduction in the energy index, and this is mainly driven by reduction in crude oil. Crude oil reducing because of two main factors: the subdued global growth, therefore demand hasn't grown that much, and also the restriction that had been put there by OPEC countries to reduce production are being removed. So we expect to see increased production from the OPEC countries, and so we expect to see increased production of oil and reduced or at least subdued demand. So that impacts on the pricing of oil. We see the same with non-energy commodity prices also reducing overall in this quarter we are reporting on, though for the year increases slightly by 1.3. So the good thing, maybe we don't have the details here, but when you look at the commodities that we export, minerals, coffee, tea, we see prices rising this year, and that you see its impact in our export numbers. So with these commodity prices reducing globally, inflation for the global inflation is reducing, continues to reduce, expected to be at 5.8 this year from 6.8 registered last year and from above 8% we had in 2022. So as I said, the measures taken by different central banks and the opening up of trade routes, people getting to see how to work around the Ukraine-Russia war, has had an impact on this reduced global inflation. Sub-Saharan Africa remains high, mainly because of about 4 big economies: Nigeria, Angola, Ethiopia, Ghana. Their inflation remains really high, and that has kept the continental Sub-Saharan African inflation high. But when you move to the next slide, now talking about the Rwandan economy, as you heard from the Institute of Statistics, we had strong growth in the first 2 quarters of this year, averaging 9.8%. We expect this strong growth to continue in the 3rd quarter of this year. When you look at the numbers, we track the composite index of economic activities growing at 23% in the 3rd quarter. So overall, in fact, you saw the numbers that were released after the IMF mission here. So the projected growth of 8.3% for 2024 for the economy. We are confident that it will be achieved because we see strong growth in the 4th quarter, in the 3rd quarter of this year. Going to external trade improvements in the 3rd quarter in our exports are growing at 13.5%, mainly driven by the traditional export. We saw a big increase in coffee export earnings, both in terms of global prices, but also the volumes increased. Also increase in exports of minerals, export earnings from minerals and tea. So this has contributed to this strong growth we see in the 3rd quarter. Though overall for the first 9 months, again, we see positive growth in our exports at 4%, though lower than the growth in imports of 6.7%. Though in the 3rd quarter that we are reporting, the growth figure for exports were bigger than for imports. But because the imports are growing from a stronger base compared to our exports, the trade deficit continues to widen. Both in the 3rd quarter, we see trade deficit increasing by 5.7%, and for 9 months, it's increasing by 8.3%. And this trade deficit has continued to exert pressure on our exchange markets. So for the first 11 months, up to just yesterday, the depreciation had reached 8.39% for this year. So much lower than the high depreciation we had last year. But we expect by the end of the year to be around 9.4% depreciation to the end of the year. And so this is really linked to the pressures on the demand for foreign exchange compared to the supply. Moving on to the money market interest rates, or market interest rates that we track, that are our channels for monetary policy transmission, we see the interbank rate reducing following the reduction in the policy rate that we announced in May. So the 3rd quarter of this year saw the interbank rate reducing from almost 8% to 7.26%. The reduction or slight increase in the lending rates is mainly linked to short. Yes, this is linked to short-term loans dominating the total mix of the loans from the banks. It's not really linked to the increase in the policy rate. While the increase in deposit rate that had started from beginning of this year was linked to our tightening of last 2 years. So we expect to see as we continue to keep an accommodative policy, maybe to see that reducing going forward. So on inflation, that is our main focus. We see this has been in our band since 4th quarter of last year, and continue to reduce this year to 4.1% increase in Q3 of this year. All the components of inflation. So we saw reduction in the in core inflation, mainly linked to core food, rice, sugar. We saw that reducing. Energy inflation slightly increased, mainly because of the base effect of solid fuel. The prices were very low in the same quarter last year. And fresh food has really reduced because of one also has some base effect, high inflation on food in this period last year, but also good performance of agriculture from the first 2 seasons of this year. So inflation continues to reduce, and as you see on this graph, and again, as you saw, the publication of the Institute of Statistics for October, it stood at 3.8%. So our projection is that on the next slide, inflation for this year is going to average 4.6%. For next year, we've revised it slightly upwards. If you remember last time, we were telling that it will also be around 5%. But because of the unfavorable weather conditions we've had for this season, so we expect the performance of maize, some key agricultural products for season A beginning December, will not be as good as earlier projected. So we expect to see some pressures on food prices, and therefore that has led us to increase projection of inflation for 2025. At least the rest of the country, we've already seen good performance in some vegetable products like potato. Inflation prices have started to reduce because of high harvest, but we expect to see pressures on maize and beans because the Eastern Province had big challenges of rain. So these are the projections for our inflation for this year and next year. The caveat down there is just this is projected based on normal conditions. We don't expect any heightened pressures in the linked to the conflict, whether Ukraine or the Middle East. So with this, the Monetary Policy Committee has decided to maintain the central bank rate at 6.5%, one because of the uncertainties on agriculture performance for season A. But we think for now it's good enough to maintain inflation within our band of 3 to 8%. Though as you saw, though 205 is increasing to 5.8 compared to the 5 we had projected in August, but still within our band of 3 to 8%. So that's some of the outcomes of the Monetary Policy Committee meeting and the decisions. Now moving on to the Financial Stability Committee meeting, the committee noted continued increase in assets of the financial sector, increasing by 23% in the first 9 months of this year. And in fact, not just increase, but also increased deepening of the financial sector as the percentage of assets of the financial sector to GDP continue to increase, standing at 68.2%. This was mainly driven by increased earnings from last year that were retained and increased deposits, also increased contributions, and in some the non-bank sector, we had some increase in capital. So that is mainly the drivers of the increase in the assets of the overall financial sector. Now breaking it down to the subsectors, starting with the banking industry, the biggest subsector of the financial sector, we see the assets of the banking industry continue to grow strongly, mainly driven by, as I said, retained earnings, increased deposits, and this allowed them to increase their lending to the private sector. The new authorized loans for the first 9 months increasing by 25.4%. And even outstanding loans also continue to increase, slightly lower than what we had September last year, the first 9 months of last year. But this can be linked to this. We we told you this last time, there are some 3 microfinance banks that were moved to the microfinance institutions subsector. But generally speaking, there's very healthy growth of assets of the banking industry. So where we focus mainly is on the stability indicators, the capital adequacy ratio, a measure of how banks are able to absorb any shock, remain to be strong at 21.2%, compared to a minimum of 15% that wouldn't allow them to go below. Those slightly lower than what we had September last year, which is linked to the increased lending. As I said, the more they lend, the more they increase the risk-weighted assets that are compared to the capital they are sitting on. So, but still very healthy and gives us confidence that they'll be able to absorb any shocks. Continued improvement in the quality of the loans with MPR at 4.2% in September. And this is linked to continued efficiency in the underwriting, but also some write-offs of non-performing loans that had stayed in for beyond the required period. Liquidity also remains strong, 324 compared to 100% that is the minimum required, and continued profitability, increase in profitability of the banking industry, that most of it, as I said, is returned to support continued investment and lending to the private sector. Microfinance sector, more or less the same story, increased assets because of more deposits and increased outstanding loans. Of course, this is also driven by the 3 microfinance banks that joined the microfinance sector. That's why you see this high growth of assets by 40%. But generally speaking, when you go to the next slide, showing the stability indicators, the microfinance sector also remains very strong. Either capital, quality of loans, the liquidity ratio, the profitability continuing to increase. So we also see a healthy microfinance sector. And again, as you heard, we said that the other day, but Minecofin had announced the completion of the automation of the SACCOs and starting the process of consolidation of the SACCOs. So we also expect this really to strengthen the quality of the service and the sustainability of the SACCOs going forward. So we expect Kigali to be finalize the consolidation of SACCOs in Kigali by the end of this year, and overall by end of first half of next year, we should have seen all the SACCOs consolidated at district level, and that will form strong financial institution that will serve the population at the district and continue to serve also at the local levels, Umurenge levels. On the insurance sector, also improved assets, continue to increase the assets, both life and non-life. Improvement in premiums. As the economy grew, we have more vehicles, we have more assets being insured, and so that increased the premiums, and also diversified investments of their resources that increase their investment income, that allows them to continue at least on the profitability side as well. And the other key factor that we've been monitoring is on the underwriting profits. So we see this continue to improve, and this shows a healthy insurance sector compared to 4 or 5 years before. On the stability indicators for the insurance sector also remain strong, with solvency ratio, liquidity ratio, and continued improvement in their earnings. That gives confidence for stability and continued growth, and support risk mitigation of economic actors. the pension sector, here we just show you how the assets of the pension sector, the three categories of pension, the public pension, RSSB, the private pension firms, and the EJOHEZA, they all continue to increase, both in terms of assets and in the contribution they're getting from their members. And so this helps the sector to continue growing as well, and it's healthy. Payment system, we just show you how we continue to deepen digital payment within our economy. So this shows the transfer and payments in terms of volume has increased, in terms of value, and active merchants and unique users has also continued to increase. As you see on the next slide, as a percentage of GDP, the digital retail transactions has really increased to 244% of GDP compared to 165% we had the same period last year. So this shows a strong deepening of the digital financial services, and we expect to see this strengthen even further as us, which is finalizing the shift from the original system they're using to a modular loop system that will strengthen their interoperability services and link them to our payment system as well. So in summary, we expect to see a strong and sound financial sector going forward, sitting on strong capital, healthy liquidity, and continued profitability. And of course, we continue to monitor and be ready to take action if there's anything that will disrupt the stability of the financial sector. So briefly, that's the summary of the outcome of the two committee meetings. We'll be happy to receive any questions from you linked to what we've told you. Thank you.
Thank you, Governor. With your permission, we'll take
All right, John Rwamgambwa there, the central bank governor, on the last 2024 MPC meeting. And what we have there is the policy rate maintains at 6.5%. Kevin, I know this was your expectation, maintenance of the 6.5% central bank rate.
Yes, it was.
Yes.
Looking at where we've come from in 2024 from an inflation perspective, where economic growth is as at now, the expectation was maintaining 6.5%. Also, as we wait to see how the world looks in 2025.
Let us speak from a financial sector growth perspective. What are the key drivers of the strong growth that we have just seen in Rwanda's financial sector, and how sustainable is this growth, and what challenges maybe lie ahead looking at 2025?
So looking at it, the financial sector in Rwanda has grown, mainly driven by banks, by growth in assets from a banking perspective. And it also stems from a strong and conducive economic environment. If you're looking at economic growth, has been strong, even in periods where inflation was tight and was sticky for a long period of time. But we've seen that the sector has still continued to be strong, to be resilient. Also, financial inclusion, the continued or the increasing financial inclusion in Rwanda of financial services has also contributed a lot to the growth of the sector. Also key, something that Governor has mentioned in the briefing just now, the process of automation of the circles, the Umurenge circles.
Yes.
More than 400, I think it was a count of around 402 circles were automated. And this has just helped at least to include more people into the financial into the financial sector. We're also seeing increased penetration of banking, of the banking sector as well. You're also seeing more automation, more innovation in coming up with products that can target a wider range of citizens rather than what we are seeing in the traditional banking and even the other sectors.
And Kevin, let us look at the interest rate here and also the lending rate. What impact are we likely to see on the commercial banks' lending rates in the short and also long term? And also maybe factors beyond the policy rate. What influence are we seeing on commercial banks' lending decisions, and how might these significant impact the factors that comparison to these policy rates?
Lending rates have been sticky, and even looking at Governor's presentation today, lending rates in Q3 were actually a bit higher, a few basis points higher than a previous period last year, even when the policy rate has come down. And generally, looking at liquidity, looking at credit risk, these are some of the other factors that the banks are also taking into consideration when looking at their lending, and it's probably why we are not seeing them come down in accordance with the policy rates, and also the fact that the banking system also has a high number of legacy loans that were priced higher when the policy rates were higher, 2022, 2023. But now the volume of the new loans is still yet to affect the average lending rates.
Yeah, and also something the governor has mentioned is the liquidity that you are seeing when it comes to mopping up liquidity in banks. So let us look at the management aspect of it regarding the monetary policy. So I am keen on market operations, how they have been in Rwanda in terms of managing liquidity, particularly during periods of economic stress or rapid growth, and also the potential risks and limitations that we are likely to see in terms of relying heavily on open market operations for liquidity management.
To be honest, the markets have been fairly liquid, very liquid. If you're looking at issues, even government issues for the last a period of the last 9 months, they've been oversubscribed, both on the short term and also on the long term. So markets generally have been highly liquid during this period. And what we've been seeing from the central bank is actually mopping up of liquidity through reverse repos. So that has been quite prevalent in the market, and especially on the shorter end of the curve. For example, a good illustration is last week. If we look at the auction last week, we had a 3-year paper in the market and a reopened 15-year paper. The subscription rates on the shorter end of the 3-year paper the subscription rate was 200%, which was double that of the long term. And this just illustrates the liquidity in the money market, and which has also been boosted by lower interbank rates. Banks are doing more business amongst each other, providing liquidity. So they've been able to manage it themselves, not really having to rely on maybe facilities from the central bank. And in any case, the central bank has actually been mopping up liquidity rather than having to inject liquidity into the market. And
this is a maintenance of the monetary policy at 6.5%. What impact are we likely to see it have on commercial banks, the lending rates for commercial banks?
We expected lending rates to continuously come down, but definitely due to some strains that we've mentioned, such as the credit risk, for example, we're still seeing that banks are still reluctant, looking at their profiles, that they're still reluctant maybe to bring down rates on some of the clients. But as we continue also to see improving conditions, we expect that maybe the new loans will be issued at lower rates. But also one factor that may play into that is also performance of some of the subsectors. For example, agriculture. If agricultural production falls in the second season as compared to the first season, then we might see some stickiness in terms of repayment of credit from such a sector that is very key. Almost a quarter, contributes almost 25% to economic growth. Then if it's tight and they're not being able to repay, then we definitely don't expect loans to the agricultural sector to have lower rates.
And Kevin, I'm also looking at what the governor has just also said on the trade deficit. We saw that it widened. So let us look at imports. The imports grew from a stronger base compared to the exports. What are we seeing here? What are some of the factors contributing to these strong imports compared to the exports, despite exports also doing extremely well?
In fact, exports did well than imports. If you are looking at a percentage growth, exports grew 13.5%, imports grew 8.5%, but it's a volumes game that that plays into the currency and to the trade deficit, given that in as much as exports grew more than imports the volume there is much bigger, being a net importer. And a stronger US dollar doesn't help in that situation, given that the import bill will continue to be inflated and generally weigh down the trade balance, and in this case increase the trade deficit. And then now that definitely translates to a currency point of view, that expected depreciation given the nature of the trade balance, and also given the stronger USD.
And also I've seen the SSA, that's the Sub-Saharan Africa inflation, high at 8.3% compared to the global inflation. Maybe just a comparison here briefly.
Also, most of the SSA countries, except those that do a lot of oil exports, both of them are heavily reliant on imports. And higher prices, higher commodity prices, higher oil prices, or volatility in oil prices, they definitely play into the inflation game. And also, if you look at also global inflation, also driven largely by the performance of the advanced economies. If you're looking at USA, which the biggest economy, inflation rates of about 2.4 to 2.6%, then it definitely weighs high from a global perspective. But from an SSA perspective, given we are majority are net importers, at 8.3%, and looking at where we've come from, then it's a step in the right direction, but yeah, we are not yet there yet.
So as we wrap up our conversation, what are some of the factors are we likely to see perform exponentially well from this December and the first quarter of 2025?
Definitely, agriculture is a bit out of the box at the moment.
Yes.
But we expect to see like trade continue to perform well, given that we are heading into the festivities. We've seen that imports, especially during this period, have picked up. So we expect to see trade continue to run. And also a big one, which is also might help to ease some of the pressures that we see from a currency point of view. Expect to see the services, tourism, accommodation pick up as we head into the festivities, as we welcome higher tourist numbers into Rwanda. That is also going to also help to ease some of the constraints that we are seeing from a currency point of view.
Indeed, Kevin, thank you so much for those great insights, and always a pleasure to have you in our studios. Well, that conversation takes us on a break. We'll be right back with more.